So what did we get to today?
We reflected on the offsite and reminiscing of the weekend that was.
Such a good weekend.
It was fantastic. And then there was a bit of a theme to the news this week, resourcefulness versus resources, and how having too many resources can sometimes lead to your demise.
Yeah, and with Bird that had been delisted from the New York Stock Exchange, having raised around about 1.4 billion and achieving a market cap of nearly 3 billion and now falling 99.9%. That was a company that certainly couldn't use resources to achieve success. That led us to talking about some employee trends. Analyzing the revenue per employee was quite interesting and how that has changed in a post-COVID world.
Yeah, and we compared different sectors to the tech sector in terms of revenue per employee and had a little chat about what the impact of AI might be on productivity going forward. And then we talked about the SaaS metrics report from OpenView Partners and talked about why these types of metrics are important for founders to be looking at.
And there were some really fascinating results in there, just around year-on-year growth rates, different metrics.
Yeah, and a few investment type metrics, which then led to our really quick look at the pitch book data for US VC valuations.
Yeah, and there seems to be some continued trends there, so that was interesting to discuss. And one of the trends that we had seen is that there just hasn't been the unicorns minted, so to speak, as there has been in previous times. And there was a post on LinkedIn talking about where do ANZ, Australia and New Zealand's unicorns come from? Are they first-time founders or are they serial entrepreneurs?
Yeah, and a nice little chat just about our own preferences for serial versus first-time founders and how that plays out. And then we ended, of course, with a little chat about Elon Musk and SpaceX and some news that appeared around some workplace incidents happening at SpaceX.
That's the world's serial entrepreneur.
Yes, but all up a good chat, and resourcefulness versus resources seem to be the theme.
Well, let's resourcefully get into it. How are we?
Sensational. I'm feeling good.
Wow, that's a bit aggressive, Aaron.
You got a new haircut as well. He's looking great.
Yeah, I wanted something that was low maintenance. So I went in and asked a man's midlife crisis haircut, and they said, "You're after the Don."
Short back and sides.
All right, Lieutenant Dan. I'm sounding a bit rubbish and feeling a bit rubbish myself. I made a comment to someone a couple of days ago that we've got family photos coming up, and recent events have probably seen me accessing a few too many calories and just put a little bit of the winter coat back on. I lamented that it would have been better had I have not done that prior to the photos, but I'd say that the universe listened to that and then said, hey, I can help, and has provided me with something that is seeking to reduce brain function and weight loss.
I'm feeling sensational after the weekend. Like we had the offsite this weekend, and those things are just soul fuel. So
yeah, no, that was a really great weekend. What were your takeaways, Jack?
I always love these offsite submissions. Like, I think the best part of these is getting to know the founders and the participants on the tour. There's just something about going away and spending some time detached from reality, and you really get to know the people when you come back with 20 new friends. That was my biggest takeaway.
Yeah, no, I think you're right. People are a product of their environment, and unless you get out of that environment and have some time, that cliche, you've got to work on the business, not just in the business, and this is that environment.
Yeah, just drawing that energy from all the founders. There's nothing like working with entrepreneurs that are there in the trenches, doing it, having a crack, and it's why we got into this game, right? Like, that's the fun side of VC, working with the entrepreneurs.
Yeah, I also loved on the Saturday night just everyone sharing their learnings from their journey. Like, everyone's had a different journey, and it was just to go around, and it was so raw, and just hear how everyone's experience has been to date and what they can learn from each other.
Yeah, I think especially when some of the people there and the investors have had what some would think is a really successful straight line path with all the rewards, but when you actually get to spend some downtime talking about the actual journey, the challenges that had to be overcome, and the common patterns that people then face in their own business that they can then learn from. Yeah, I thought that was very powerful.
Yeah, I think the sharing that happens there is just phenomenal. And for early stage founders to hear from some later stage founders just what it has been like for them, and to normalize some of those emotions and normalize the journey is incredibly empowering.
Yeah, having different companies at different phases of the life cycle is important because the young ones, the young life cycle location companies can look at the next few steps ahead. And then the older life cycle location companies are then looking at the next steps ahead. But even the ones at the older phase of the life cycle have still a lot to learn from the younger phase, and that flexibility that they used to have that maybe they've lost, that innovation that they may have had now gets caught up in the day-to-day grind of business as usual operations.
Yeah, and I think as well, Friday night, bringing in 20 guests, different investors and advisors and ecosystem contributors, that for me was a real highlight, like the buzz and the conversation. So
Yeah.
I'm already counting down to our next one in February.
Yeah. So we run two types. There's the more individualistic, that's really around, we call it action planning, but it's really about more that humanistic side.
Yeah, we need a better name for it.
Yeah.
but it is really about, the theme is scaling for sustainable growth. This offsite we just held was around the organizational aspect, the business aspect of that, whereas the February one is around the individual humanistic aspect of that.
So for any listeners out there, the name Offsite needs to change. So we'd love to crowdsource any ideas that
Yeah, send us your suggestions.
you've got. Out of that Offsite, there are a number of themes that we were talking about, and I think we can dovetail that into some of the news items that have popped up. And I think it was on the Sunday, one of the LinkedIn articles that we saw about Bird delisting from the New York Stock Exchange, which was quite interesting in that Bird hadn't been able to keep a valuation of more than $15 million, not huge money, for more than 3 months. And considering that it had raised 1.4 billion and had reached a market cap peak of $3 billion, it's just amazing how far it had fallen.
Yeah, to go from a 2.5 bill value in the private markets to 3 bill on after listing to now 12 million. It's an interesting space, this scooter space. $5 billion has been invested in scooter startups. And I find it quite fascinating. It's not a market segment I've ever understood the appeal of from an investor perspective.
I think there was a lot of hype around this was like the last mile of mobility of the transport system. Technology had gotten to a point now where it was cost effective and affordable. The hardware and the software started to work really well. But it does highlight that any business that ends up playing in a commodity product with no barriers to entry, subject to competition, just gets flooded with capital to the point that it just can't get that capital back. And when you can't differentiate from your competitors, the problem is your pricing power goes out the window and you end up just going lower and lower until you just can't get your capital back.
Yeah, and a very capital intensive model, right? Buying these scooters and deploying them. And I remember hearing from a scooter founder it's quite early, and I can't remember which company it was, but we were in San Francisco, and he described it as a land grab. Like he saw a first mover advantage in securing different councils and getting those contracts. But for me, the question mark always was, like we know with councils, those contracts do often come back up, will usually come back up for tender again. And they're very prone to the public sentiment and competition entering the markets. Yeah, in this case, I think one of the themes from the weekend was around resourcefulness versus resources. And I think this story kind of highlights that you can have all the capital, you can have all the resources and still ultimately fail in the end.
Yeah, and entrepreneurs, I think, prior to this down cycle have had a lot of access to capital. There is no Bird or Lime or any of those without an unbelievably massive upcycle in available capital at unbelievably low interest rates. The first time I saw scooters around, I think, was when I was in Paris on a pre-kids, pre-marriage, when you're young, happy, and just living large, like Jack over here. Your time will come. No, I joke. And then when we got back to Australia, came out of the apartment in South Bank, and there were these Lime scooters. And for me, it was awesome because it did give that last mile, but the problem was it just wasn't a functional business model, and it got the size that it did just from rivers and rivers of capital. And even though the numbers are really big, I think the lessons for entrepreneurs at a smaller scale, product market fit clearly occurred here. Like the customers liked it. The customers continued to use it. So obviously product market fit is required, but not sufficient. But then there needs to be the ingredients of capital efficiency, competitive differentiation, barriers, and too often we're told if you just get product market fit, you're going to be able to build a successful business, and this highlights that's not true.
Yeah, great. I think, to add to that, Don, like obviously you need to find product market fit, but that's not enough. And it's actually finding a competitive advantage. And if we look at Lime, for example, or any council in Brisbane, we get offered 3 different scooters we can hire. Like there's the green one, the orange one, and then another one. So of course, like if you're the first mover in there, you've got pricing power. But as soon as competition gets in there, and then we've got a choice as a consumer, I'm choosing the cheaper one. So margins get squeezed. It's just a downward spiral.
It's interesting. I had to get from Howard Smith Wharves into the city the other day, and the 3, exactly how you described it, Jack, like the orange one, the purple one, the lime. But I went with the one I didn't have the app for just because it was a cooler looking scooter and I wanted to try it. So
totally irrational.
Totally irrational. And I got so frustrated myself because I had to download this new app, sign up, and I'm like, why did I not just jump on the lime that I already had the app for? But I have no loyalty to it.
That's why distribution is so important. Like Lime got in with Uber because like I don't want another app on my phone, but I know because I've got Uber, I can then hire a Lime through their app. But even still, like you chose the cooler looking scooter.
Yeah.
Oh God, it's a hard.
We should unpack why Aaron would feel the need to go with a cool looking scooter, by the way, but maybe that could be
all style, no substance.
Yeah. But it was one of the themes of the weekend that we went into, because I think one of the early concepts we discussed is this idea of required but not sufficient. And there are so many things in the entrepreneurial journey that are required and not sufficient. And the things that entrepreneurs are told to focus on are often the above the water iceberg aspects, but below the water is the bigger part of the iceberg and the bigger part that leads to success. And that's where we like to concentrate. And one of those themes continues on this resourcefulness angle. And there was an article that came out from Tomas Tungas, a venture capitalist at Theory, and he had published an article and had done some analysis around number of employees based on different revenue bands. Did you get a chance to see that?
Yeah, I find this really interesting, revenue per employees. I've actually been looking at this previously, specifically for technology companies. And this came about with a policy advisory kind of hat on at different points in my life. Government's looking at where should we be investing public sector money to support industries and build high growth ventures. And I actually it's interesting for me, like I have this chart here. Can I share my screen? Yes. So I have this chart here, this one, which is revenue per employee specifically for technology companies. And Netflix actually tops the chart.
Yeah.
The one that's interesting for me is Apple. Like, given there's a lot of hardware that Apple ships.
Netflix, they get to go and leverage everybody else's IP and then sell it out. And the same with Apple. If you look at a lot of those, Alphabet is leveraging everybody else's data online. So there's a pattern there that the highest revenue to employee is leveraging everybody else's shit.
I think if you look at most of them, like even the bottom 6, Amazon, Alibaba, Tencent, eBay, PayPal, like they're eBay, all of those are leveraging other people's products
or content.
One of them that's missing that I just searched up to confirm was Craigslist. So Craigslist has 50 employees and the revenue per employee ratio is circa 14 million. Oh yeah, that's a marketplace. Two-sided. Oh, just a marketplace.
Yeah.
They're a marketplace that's reached critical mass, and now they've got the networks effect in play, and they're just reaping the rewards.
Yeah. I think one of the key points of some of this data is that across a range of reports that we've seen is that the revenue for employees increasing, i.e. the number of employees is decreasing as the world has to become more effective and efficient.
Yeah, productivity way up, revenue per employee across sectors. I think that was the interesting thing for me with this one was they're talking here about all different types of companies in all different sectors. This trend curve continues. And in the world of AI, I think it's just going to see that J-curve effect and even more revenue per employee, more productivity improvements.
Come to the offside. This was in the brochure, wasn't it?
I really love our startup ecosystem, and I like the community that Tribe's building. It was great. It was a great opportunity for me to connect with the community, get to know people like you, Melissa, and just genuinely, take the time out from work to think about what are the mechanics of my business and what can I do as a founder to continually grow.
It was a great sort of temperature check of where the business is at across some of the content, and that's always helpful because half the time you don't know if what you're doing is what you should be doing.
Getting to spend time with founders in a space that takes you out of the day-to-day, takes you out of the busyness of working in a big city, and I think this location absolutely nails that.
Being together with others, sharing your stories and hearing how similar in some ways they are to everybody else.
And how great has that been?
Yeah, it's really refreshing. Yeah.
Being able to disconnect, I suppose disconnect in order to reconnect with other people, the other founders, and then also with the core missions that we're operating our business in.
I think this weekend's been a really powerful way to just get really clear on what tools work and how could I implement them quickly and effectively into the business, given that everyone's business has got different dynamics and different people, and you really got to be respectful and considerate of the team you've got in place.
And the other thing is just the empathy that all these other founders show for one another. I feel like the founder journey, you hear it all the time, can be quite lonely, but I feel like you hear these anecdotes here over the weekend. I think that just helps to bring that to life.
I think it's really great to be with companies at different stages as well, because you can learn from the ones that are a little bit ahead of you, and so it's been surprisingly a similar story from lots of the people here.
And knowing that everyone has problems at every stage of the business, it kind of frees you up to de-stress about the problems that you're facing today, and you go, okay, this is normal.
Yeah.
I'm not the only one. I now know some new people who are going through the same thing, so I can hopefully reach out and sort of talk, hey, how did you get past this?
Yeah, that's right. And there was a lot on the last 2 days of talking around, companies are similar to humans, and that organic nature of how things develop, and we shouldn't all just be necessarily thinking that we need to be billion-dollar companies in 2 seconds.
Definitely think, problems are a natural part of building, growing, scaling a business. But actually just walking away with really an acceptance that, okay, that's going to happen, but the tools and frameworks that were shared really made it easier to actually kind of cope with those issues as they come and actually build it into the structure of the business, so that as you move forward, you're constantly dealing with them so that they don't go out of hand. Yeah, that was the huge takeaway for me.
These are actually very simple systems that doesn't matter what stage you're at, that you can implement and get really, really solid results, because it is that, your team is your engine. If you don't iron those things out from the very beginning, you're going to have problems all the way down the journey.
As an investor wanting to make a difference to my portfolio, I believe that if I can help my portfolio succeed, that's going to increase the enterprise value of those companies. It's going to make them more likely to be able to get to the next milestone. And so there are lots of really practical tools that I can now use when I'm having a conversation with the startups that I'm invested in, to just go, hey, have you thought about this in that way? And so, I think there's great opportunity for investors to come along to this, and also gives an investor a great opportunity to meet cool startups and see what's timely and relevant in the market.
In my previous life in the professional services game, we were always targeting, I think it was somewhere between 3 and 4 times employees' total cost as revenue. And if you did that based on our cost base, your net profit was around 30%, which is what professional services are always trying to do. So each business will have its different ratios. I think it's important for companies to know what theirs is and what they should be striving for. And when we get to the benchmarks report a little bit later in this episode, there's some data around that as well, because it changes at different phases of your growth. So your revenue per employee between the 0 and 5 million ARR mark is way different to the 10 to 20, which is different to the 20 to 50. So it's being careful to make sure that you compare yourself against companies that are actually at the similar ARR and life cycle location.
Yeah, completely.
And while we're chatting about benchmarks, it's probably, before we do a deep dive on the report, it's probably just worth mentioning like why founders should take note of these. And it's really, benchmarks are just a map. And as we'll see, and it's displayed in the report, like these SaaS benchmarks just serve as a map for addressing your position relative to your peers. And it's not something you should be checking every day. Like this is just something come back once a month that your team can go back and just compare where you are versus the top quartile of where you want to go.
Totally. And sometimes where you are today is not all that relevant. It's, am I getting better or am I getting worse? Is my rate of change improving? And at the offsite, one of the participants from KPMG High Growth Ventures, who I was really grateful to spend some time with, I didn't realize the great work that they did so broadly for a lot of companies, but one of their participants who had been a founder as well talked about constantly setting almost games for their staff to look at competitors, keep driving towards those competitors, having that North Star of competition at every little phase to keep trying to improve, keep trying to optimize. And these benchmarks help you do it, because even if you achieve greatness in one benchmark, you probably have other benchmarks that you can improve. So you just keep fostering a culture of improvement by having a look at what the top quartile or the top decile are doing.
Yeah, it's that point is so fascinating around using metrics and actually sharing them with your team as a means for building motivation. There was a factory in the US and they were struggling to increase capacity of their production lines, and they appointed a new factory manager. And all he did was, at the end of the night shift, write on a big blackboard down one end of the factory the total number of units that were output. No context for it whatsoever, just a number on a board. And the day shift came in, saw the number, had no clue what it was. There was a lot of chatter, and eventually worked out, oh, that's the number of units the night shift put out. So, of course, they wanted to beat it. And so then they crossed it out, wrote their number. Anyway, this just kept repeating over the shifts, and productivity went absolutely through the roof just by having a metric that was measured and shared as a team.
I love that. When you gamify it, the competitive edge comes in.
Yeah.
That's even like Strava. Like, Don sees your Strava, Aaron, he's got to go for a run.
Yes, whenever Don's out there running and I get the notification and I haven't, it's like, okay.
He's actually in the buggy. He's in the buggy doing laps around the property. So it's probably worth jumping into the OpenView SaaS metric report. So that got released over the weekend. Jonathan and Matthew from Userback, who were on our offsite, they actually pulled it up for us. So that was really great. So in essence, last year, the report was all about whiplash. So the number of newly minted unicorns fell by 80% and valuations got a reality check. But while the value of growth fell sharply, there were a few silver linings, and that was SaaS companies were still growing reasonably quickly. So if we fast forward to 2023 and this report, public SaaS valuations are back on the rise, which is relevant to growth rates. And thanks to the hype around AI and some inflation relief, but at the same time, customers have stopped buying software like they did in 2021.
Yeah, I think one of the big things that I take away from it is that there's the company's performance, and then there's the broader market performance, and across everything, customers are just pulling back, and we're seeing that with our portfolio. It says here that SaaS buyers have been scrutinizing their software purchases and consolidating vendors in challenging economic environments. We're seeing more and more companies add more functions that are not core, but to try and retain users within their ecosystem. And I think this is one of the drivers, that as customers seek to consolidate vendors, they're going to want more functionality from the vendors they want to keep.
Yeah, it's such a good point. We talk about this a lot as a team when we're looking at potential investments, is what is the real ROI of the product or service? And just, we invest in pretty boring stuff that's solving real hair-on-fire problems for businesses. And we look for these types of characteristics that do survive or even potentially thrive in the economic downturns. The other interesting thing for me with these types of metrics, just going back to Jack, your comments about benchmarking. I think the value for founders here in looking at lots of different metrics across the business is that you can identify the tweaks that you can make to get some wins. So often, I remember there was a report we talked about on one of the early podcasts where it was looking at how to the value of reactivating churned customers, for example, and having some metrics around that. And I think for founders, it's the more of these types of measures you can have, the more you know the levers to pull or to tweak in the business to get growth, rather than just simply resorting to, let's have more resources to go and capture more market, put more people through. And going back to the Scooter example, meanwhile, you've got high churn and you're just bleeding cash.
And there are two ways I think that these metrics can get used. Obviously, the internal that we've just discussing, to be able to benchmark yourself, be able to gamify internally, be able to give some context to employees, be able to KPIs. But these benchmarks are absolutely being used by investors like us.
Yeah.
Like, in order for us to work with our investor base and for us to firm up a view on an investment opportunity, we have to plot it as to what is its rate of change. Is it improving? Is it accelerating? Is it decelerating? Where does that live relative to top decile performance? And so understanding that investors are using this information, even if you don't provide it in your deck, these are the questions that are going to be asked. So then that way we can do some benchmarking ourselves and get an understanding of where you sit relative to the other opportunities.
Yeah, completely.
Why don't we do a deep dive into the report itself, so then that way listeners can actually understand what we're talking about? Share my screen. So they, on the website of openviewpartners.com/the 2023 SaaS benchmarks, it kicks off with the bad. SaaS growth rates continue to compress. And for those listening, they plot a whole lot of well-known brands such as Atlassian, Snowflake, HubSpot, Viva, and all of them, I can't see one that's not, all of them have had compression in their growth rate. So as an example, Atlassian growth rate has gone from 34% down to 29%. HubSpot, 42% last year, now 27%. ServiceNow, 28 down to 21. One of the biggest ones, Snowflake, which was a big listing, that's down from 98% to 60%. And so across all SaaS, they have said that it's 28% growth rate down to 21, and all product-led growth has moved from 45% to 29%. So that's a really interesting visual, that one.
Yeah, that's incredible. So that wasn't in the report. That's on the website, but that's phenomenal.
Yeah, it's a big deceleration. And so what that is going to affect is that's going to affect multiples, because the multiple that you can get partly is to do with your growth rate. And if some of the biggest on earth aren't able to maintain historical growth rates, that's obviously going to cause some interesting challenges for the rest of the market.
Yeah. Yeah, there was an interesting stat in the report in the last 12 months from Q3 21, last 2 years from Q3 21 to more recent, the valuations had plummeted from 46 times revenue to 11 times revenue.
Yeah, so and we talked to some founders that sort of say they're gonna wait out until the markets return, but I'm old enough to remember. I'm old enough to remember when you got a multiple on your profit, because profits mattered. So until we go back to talking about multiples on profits, I humbly submit that we haven't got back there yet. But then the website talks about the good, however, pockets of resilience. And so it talks about, whilst there's 48% growing slower than last year and about 25 growing the same, there is about 25% that are actually growing faster. Now, who they are, they say they are AI native, vertical SaaS, people monetizing AI. So those are the three criteria they see for the outliers. And they just give an example that OpenAI, which distorts the figures a little bit, last year had $28 million annual run rate, and this year's $1.3 billion. So just phenomenal growth.
That is huge.
And then they talk about just add AI. Okay, maybe not. But AI native companies in the survey were 3.3 times more likely to be outliers. So that's interesting. That's on the front page of the website. Let's jump into the report itself. What were some of the key ones that you guys think we should call out?
There was one there for me, back to the point you just said then about founders delaying their next round as much as possible. Slide 25, at the Series A stage, something like 66% of companies haven't raised. Yeah, that one just there. Yeah, Series A stage, there's and beyond, there's a lot of companies that haven't raised for a while that are due to come back to market. Not knowing this slide, though, what it doesn't tell us is the underlying cash position of these companies. But just in terms of a typical cycle of capital raising, typical runway you raise in a round, it suggests that there's some companies due to come back to market.
Yeah, and the Series B being the biggest that haven't come back in the last 6 to 12 months.
Yeah, which correlates to the downturn in those stages of funding that we've been seeing in the other reports as well.
Yeah, and as we discussed in the episode, the seed market appears to be the most resilient.
Yeah, the other one for me was slide 41, that the land and expand has become the land and retain.
Yeah, so top quartile net dollar retention, 2023 versus 2022, they've all come down except for the 0 to 1 mil ARR. But I think that's probably distorted because that's really fast growing small companies maybe are able to pull that off. But anything from 1 mil onwards, the top quartile net dollar retention has all gone backwards. So 1 to 5 million ARR, it's gone from 119% to 107%. Keep in mind, this is for the top quartile. 5 to 20 mil ARR has gone from 121% to 110%. So we can see these 10% decreases. I could only imagine what the middle of the curve or the bottom quartile looks if this is the pain the top quartile is suffering.
Yeah, absolutely. Jack, any highlights for you from the report?
So on page 19, Don, we've got the top quartile year-on-year revenue growth from 2021 to 2023. The one just to point out here is the ARR under 1 million. They've taken the biggest hit over the past 2 years. And then just to point out, for example, for 1 to 5 million ARR, in 2021, top quartile growth rate was 200%. Now that's down to 100.
Yeah, it's halved.
Yeah, wow. Yeah.
So again, that top quartile. So if you're 0 to 1 mil ARR, the top quartile in 2021 was 300%. Then it went 286%, and the year just gone has dropped to 157%. So pretty well across the 0 to 5 mil, it's all down 50%. And that's, again, you can only imagine what the middle and the bottom quartile look like. And then 5 to 20, 20 to 50, 50 to 50 and above last year versus this year is all down as well. So as growth rates pair back in the top quartile, that I would say that the growth rate in the other quartiles is pairing back. That's going to have a continued long-term depression on valuations. And so some companies that we've been talking to that they're in that 5 to 10 mil ARR and their growth is in the 20 to 50% range, they're in a lot of pain because they're seeing their multiples from a couple of years ago come back 80, 90%.
Yeah, Don, another one is on page 14. It's the financial and operating metrics by ARR. It's just to point out for employees, it's everything we've been hearing in the media, the massive layoffs, and especially for the later stage companies. So if you look at ARR over 50 million, they've nearly halved their headcount.
Yeah, look at that. Yep.
Yeah, that's a huge drop.
And what's interesting, correct me if I'm wrong, if I'm reading it correctly, they've halved their headcount, but they have increased their sales and marketing spend.
Yeah, that's my read. Yeah.
So they've got less resources, but they're putting more into that growth. So they're obviously been able to find some efficiencies there. Yeah. CAC payback in months for the 1 to 20 mil seems to be hovering around the same, but the larger ARR companies are actually finding their CAC payback taking longer, either 5 months or 6 months longer than last year. So that's interesting.
Yeah, and as a percentage, that's quite significant. That's a 25% plus kind of increase there.
One comment I'll make is they seem to have stripped out the performance results for diverse management teams, which I assume the results are still the same, just a little bit disappointing that they pull that data out because I think it's important that they keep reiterating the same message. And I think in the last report, it was if at least 30% of the executive team were women in those positions, the outsized results were significant. So just a little disappointing that they pulled that out because I think it's a message that needs to be reiterated.
Yeah, absolutely. Absolutely.
It's important that founders understand how investors use this information, because if you're coming to us for a top quartile multiple, you better have a top quartile series of metrics in a range of these benchmarks.
Yeah.
So a slide here, slide 21, they surveyed what founders are most worried about. If you have a look at what they're least worried about, it's hiring too fast. Almost nobody is worried about that anymore. So that's interesting. But the biggest thing that is keeping them up at night is the go-to-market execution. And that is definitely something that was discussed at the offsite quite a bit.
Yeah. It makes sense. I'm trying to think of a time where that wouldn't be, on average, the founder's biggest worry.
When you've got investors throwing so much money at you at multiples that are obscene, you probably don't need to worry so much about that. You worry about some other things, maybe.
Yeah, I get I get how that would play out. Maybe I'm in the world of is one should. I'm balancing where focus should be in my head versus where it ends up.
They talked about the rule of 40 remains healthy, but it's a really tough bar, and the top quartile in 1 to 5 million ARR range is actually hitting the 60% level. The median is 45%, and the bottom quartile is negative 11%. So a lot of pain for that bottom quartile. And then as it goes up, interestingly, the greater than 50 million ARR companies that participated in this survey actually have a better rule of 40 result of 43% versus 28% for the 20 to 50 mil ARR companies. So I wonder if that's to do with at a certain size and a certain scale, you can really start driving efficiencies, profitability, gross margin that maybe you can't at the smaller side.
Yeah, I found this one quite interesting. I also find the ARR bands that they have there, 1 to 5, 5 to 20, 20 to 50. I'd be quite interested to break that down. I'd love to see this, correlate some other data to this one, because I find this one quite interesting, that dip in the 20 to 50 mil ARR range and then coming out the other side of it.
I personally would prefer 0 to 1 mil ARR, 1 to say 4 mil ARR, and then 4 mil to 10 mil ARR, and then 10 to a higher number. I think those have some environmental conditions. Slide 23, startups have become far leaner relative to revenue. So in 2021, as an example, companies between 1 and 5 mil ARR were reporting a median number of employees of 57. This year just gone past is 34. And that, to what we've discussed, that is a big fall.
I'm surprised, just on that one, I'm surprised the 22 data stayed as healthy as it did in the 20 to 50 mil ARR, but I guess presumably they had more lag maybe before it became an issue.
I think they probably had much bigger balance sheets that they could push decisions off. I understand that one anyway. What are the other ones, boys? This was an interesting one. Number 32, an overlooked expense, finance, tax, and compliance. The cost of finance, tax, and compliance as a percentage of ARR, 11% of companies spent more than 15%, 10% spent 10 to 14%, 25% spent 5 to 9%, 29% spent 0 to 4%, but 27% of the respondents said no idea. Don't know and don't track it.
That one I find quite fascinating. And I'm curious, is that just because at the time of doing the survey, the founder or the respondent didn't know at that time, but still it's tracked somewhere, or they're literally, the don't track is the interesting part of that for me. Okay,
I think if you were to overlay this onto the life cycle, you'd find that the early stage companies have no idea, and the later stage companies do. I think that the life cycle would give you a better model of this, because when you're young and early and you're just trying to get revenue through the door, don't know, don't track, don't care.
There was another chart, which I'm trying to find again, but it was about the breakdown of team roles across the different stages.
Yeah, that's down the end.
Yeah, so the other one I really liked was the slide showing employee distribution across the different stages of ARR. So the breakdown of engineering versus sales versus support, marketing. And it's interesting, the engineering, it stays reasonably consistent across, which did surprise me a little bit as a percentage of total company. In fact, they're all pretty consistent across all.
Except for the customer service and support. So one of the big arguments we often have with early stage businesses is their 2, 3, 4, 5 year modeling always has them with less staff on a percentage basis, less costs, and their margins rising. What we actually find is the opposite. And this chart shows it. Customer service and support for the 0 to 1 mil ARR is 17%. But as you go along, that grows to 21%. And whilst that's only 4% on average, I bet you there are some companies that have wild variations in that, but 4% off your gross margin is a big deal.
Yeah, absolutely. And there was some other data in here, showing the gross margin shifts over the different stages. Just trying to find it again.
Slide 42 is interesting. Improving NDR, monetize new AI capabilities. So they're looking at building AI features in the last 12 months. 24% of the respondents did not launch any AI features. 31% of the respondents, AI is on the roadmap, but they haven't launched. 29% tested AI features with customers. And it was only 17% that AI is the main focus on their roadmap. Now, they then split it up into monetization. Respondents that have tested with customers and have AI in the roadmap and rolled out. Of those particular respondents, 37% did not monetize. So it was obviously some efficiency or effectiveness in the background. 31% were testing monetization with customers, and 32% were saying, yes, we are monetizing.
This will be an interesting chart to revisit next year.
Yeah. I have a feeling that did not launch any AI features is going to decrease, and AI on the roadmap is going to increase.
Yeah, I think you're right, Jack. It's going to be an interesting one to watch. No
shortage.
shortage.
You want to take the listeners through?
No, I was just going to say there's no shortage of good data in here. Some of these I actually want to print and keep on the wall. And some of those investment metrics that you shared at the start there, Jack, kind of segue well into the pitch book, a US VC valuations report that just came out recently. It was interesting. I spent last night preparing for a presentation I have to give to a visiting UK delegation that's in Australia on the investment landscape. And I was reviewing some of the Cut Through Ventures reports. And if you haven't seen those, they're definitely worth taking a look at. Cut Through Ventures do an amazing job pulling together an annual report and also a quarterly report. And the Q3 report came out about a month ago, I think, maybe a bit less. What was interesting in the Australian landscape in the last quarter was there were no $100 million plus rounds, but also a drop off at the early stage. So sub $5 million rounds had also decreased back to pre-2019 levels. Just some broad stuff that I took from the pitch book, US VC valuations. In terms of the seed pre-money valuations, they're going up. But what was interesting is that the age of the company in a seed round has hit a decade high. They're getting much older at that stage, but now the valuations are at least coming back up and hitting record highs.
Yeah. And because of some of that performance in the capital markets, like one of the conversations on the weekend was from a founder that is absolutely growing like a weed, like 0 to 6 million ARR in a matter of a few short years, with no sign of that trajectory slowing. And so that is incredibly good from a performance point of view. But the ideas we were sharing around is not to go and raise a 2021 style massive Series A to fund US or the UK, is to raise something smaller to get momentum in the US or the UK. So then that way, when you're raising a much bigger check, you're raising on the back of, I can demonstrate success and performance in a new market, rather than give me a big lick of capital, trust me, I promise it'll be okay, I'm going to go to that new market. It's just getting that sequence right in these current capital markets of demonstrating first and then asking for the dollars. That's where you're going to get your best val. That's where you're going to be able to find the most supportive investors. Whereas the COVID years were just give me the money and I'll go and do it. But as has been demonstrated, a very large percentage of founders that took big licks of capital to expand ended up blowing a lot of that capital in efficiency, because the environment was just too resource heavy. When you've got so much capital and you've got so much stuff, you end up just making decisions to try and defy gravity, and then the cash runs out, and then you've got to get back to basics.
Yeah, there was another founder at the offsite who shared that she had been offered a significant amount of capital from one investor, and a second investor offered about 20% of that capital with the advice that raise less now, get to your next milestone,
grow
and then
into
raise
your
again.
valuation, demonstrate your performance.
Exactly.
And, and it worked out really well and has put them on a really great position. Whereas if you had gone for the big lick of capital and we're now facing a down round, those are really painful conversations.
Yeah, and to your point on the resourcefulness versus being flush of resources, it changes the psychology. And when you are a little bit lean or strapped, the way you make decisions is very different to when you're flush with cash and you tend to throw more people at problems. You tend to ignore some of the warning data. And even just the emotion of decision making is very different.
Yeah, I'll work it out tomorrow. What is it? The grapes need dry, arid, quite harsh conditions in order to get the best grapes for the best wine. Some rubbish analogy like that. Can you believe it's been 30 minutes and that's the first rubbish analogy brought to the podcast? I'm a bit slow today.
We're yet to have a Donism 30 minutes in.
So there has been a little bit of conflict, though, between some Val reports, I must admit, that I've been reading. The one thing that's true is that pre-seed and seed Vals seem to all be up. But around that Series A, Series B, some are saying up, some are saying down. And I think there's a big difference between the median and the average. But the main thing, whether the pre-seed or the seed is up, and I believe it is, the quality is up as well as. And to your point, I think the reason why the companies are getting older is that investors are just waiting for a few more proof points. They want to see certain things in place that they didn't need to see the prior decade. And so understanding that, I think, is very important.
Yeah, completely agree. And it is interesting because I looked at a lot of different reports last night prepping these slides. And I think my takeaway is just we're not in pure decline anymore. Yes, there's some contradiction in different reports, but it seems to be plateauing. If not, maybe there's that start of the uptick. I think going back to something you said, Jack, one of the data points was there were no new unicorns minted last quarter. Was that the stat you referenced?
I think I did.
So that stat about no new unicorns being minted, and there was a post on LinkedIn about who's building Australia and New Zealand's unicorns. Is it first-time founders or serial entrepreneurs? And it led into a little chat, or actually we've talked about this a few times. Would we rather be backing first-time founders or serial entrepreneurs? But any thoughts on this post?
The beauty of first-time founders is they don't know how hard it is, and they're so irrationally exuberant that they can break down barriers that others are too clever to understand. But first-time foundership means that it comes with all the lessons that they have to learn. You've got to be there to support them. And that's not to say that serial entrepreneurship is much easier, because you come with a range of other experiences that if you can learn from, that's helpful. But sometimes when you've seen this movie before, it becomes a wee bit too painful and you maybe don't do things that first-time founders would because you've already got mental models that say that something can't be done.
I had a look at our portfolio, and out of the 7 investments, which is including our deal that's currently live with our syndicate, 4 of the founders are second-time founders. But a discussion we had, Don, it's circumstantial, and you mentioned, for example, you'd rather back a second-time founder in the hardware industry.
Yeah, on that particular one, because they had demonstrated in their previous startup to have understood offshore manufacturing, the challenges of warranties with regards to some of this hardware stuff, the way that hardware can have its inherent technological issues. Having some other investors in a prior startup pay for that learning and journey, I think, is good for us. And what I liked about that particular founding team was that they could articulate where they went wrong last time and articulate why they had that covered for this time. Now, that's not to say that it's going to be an easy, free ride, but when a team of people can understand why they went wrong and fix it, means that they're probably more likely next time to be able to see issues earlier and work to fix it, whereas sometimes people that haven't been around the roundabout before wait a little bit longer, hoping things will resolve. But as we've learned, hope is not a risk management strategy.
Yeah, I think in that particular case, really having that experience is highly beneficial. And I think it's quite nuanced. This experience can be gained through other roles, not necessarily as a founder. But there is something about the experience of a founder going through the emotions of being a founder. But I am reminded of the NVIDIA founder, Huang, and his comment that if he had known how hard it was going to be, he would never have done it. And the virtue of naivety and the value of that in terms of if you don't know how hard it is coming in, all the things that are going to happen, then it does
I
get you
think
to
it's
continue.
harnessing it at a different, like for us with our own journey, there have been things that we could never have forecast that if somebody had put in front of me, I'd say, oh, that's interesting. I'm not exactly sure I'm signing up for it, but because you're already in it, you just deal with it. But then we still have some, I think, interesting perspectives for the people that we invest in that we can try and help them with during those darker times, of giving some of those perspectives of, hey, this is actually quite normal. Let that one go through to the keeper. Let's work tangential where that issue will go away, versus actually this is a bit abnormal. This is where we've got to pull out of our energy. We're going to stand shoulder to shoulder with you to help you through and resolve it.
Yeah, it's interesting. Alex Hormozy out of the US, who creates a lot of content, he's a founder himself. He referenced this study into the most successful entrepreneurs, so the real top end of the bell curve of entrepreneurs. And this study identified these three characteristics that were attributes to their success. One was a massive superiority complex, so this belief that they deserve more and that they can. Second was a massive insecurity complex, a feeling that they're never going to be enough and probably live up to their parents' expectations. And third was impulse control. So it was like this drive towards something, this fear pushing them, but at the same time, an ability to focus. And
a combination of conflicting but momentum creating ingredients.
Yeah, there was this study on rats. They put rats in a maze and they put the cheese out, so the reward, and they found the rats would navigate in a certain time, but then they wafted in the scent of cats behind them, and those rats performed better. So both the pull of the reward, but the push of the fear driver led them to get a better outcome. And like, why am I talking about this? I think for me, serial entrepreneurs, what is interesting for me is if they have had successful exits, I think a little watch out is, does it change how much they want or are driven, or does it change their expectation coming into the next startup? So as much as it brings experience, I'm always conscious of how does this affect their emotional state, their decision making, their skin in the game, and those drivers that they may not even be aware of that they have, like an inferiority complex.
Yeah, to add to that, Aaron, I think that also agrees with being resource constrained. And if you take on too much capital, you then take on too much fat, and you then don't react to the cat.
Yeah. Yeah, such a good point. That's a really good point, Jeff.
Yep. Who was it that said that only the paranoid survive? There's this level of constantly looking over your shoulder. And yeah, to the point of this article, what it's saying is that it's actually 50-50. Serial founders and first-time founders, 49 to 51%, have built unicorns. Interesting with Airtree's portfolio, it's 64% of first-time founders versus 34%. So they over-index towards that first foundership, which is interesting. But I think the main thing there is, hey, there's benefits of being both, and as such, you've got a good chance, and concentrate on the ingredients that are going to lead to that, which is around go-to-market, product market fit. A lot of the discussion at the offsite was founders are very good at finding a gap in the market, a problem in the market, people that are not being served, people with problems that are going unsolved, but actually, is there a market in that gap? And one of the interesting thing about humans is just so how apathetic we can be to our own problems. And yes, it's a problem. Yes, I can see it and I can feel it, but actually I'll deal with it tomorrow, or it's not such a big deal. And whereas founders who are really passionate about it, they're like, no, this is a problem. It needs to be solved. And then there becomes this huge disconnect, this huge frustration where they can see this problem and they've got a product to solve it, but actually it's just not a big enough problem. They can't make a revenue model out of it. The go-to market strategy doesn't match, and it's really bloody painful.
Yeah, absolutely. There was, I'll tell you, you're going to have to edit this out. There was something you fucking said there, which was gold, which I wanted to go into more.
I'm not going to edit out, Aaron, because everything I said was gold. You just chose to...
Please leave that in, Don.
You just have chosen to ignore it.
I was so surprised that caught me off guard.
Oh my God, Don's actually saying something intelligent for one. I did say to someone of the offsite, so as long as you understand that even if it sounds like an intelligent thought, I've never had an original thought. And as long as you don't hold that against me, I'm fine.
I do actually remember my thought now. The other topic of conversation at the offsite was a lot of the things that we go through organizational structure, organizational life cycles, like all these sorts of things that we almost never see attributed as a point of or causality of success. So here we are with this analysis of a serial entrepreneur versus a first-time founder and whether they go on to build a unicorn. But the underlying causality is often more of those boring, systemic, structural, process-driven things that they had put in place. And yeah, I think the nuances of whether you're a first-time founder or a serial entrepreneur, there's much more to it than just looking at those sort of statistics.
One of the other things that was part of the offsite was around this idea of an organizational life cycle, and that some things are normal, some things are abnormal, and that you can't outrun life cycle location issues. You actually have to go through different phases. And people look at really big companies that are really successful, that have raised a lot of capital, and don't realize that the life cycle location issues still are relevant. And one of the issues is around systems, processes, controls. And often in an organization, some of those controls around safety, onboarding, all of those things are a bit lax. And an article came out, what it is really like to work for Musk's SpaceX, just talking about the 600 injuries reported from 2014, many serious, including amputations, head injuries, burns, and there was a death, unfortunately, of someone. And this is, investors sometimes find it hard to get their heads around and use the word should. Well, a company doing this should have all of this in place. In some LinkedIn engagements we had last week, especially around some of the stuff that we're just putting in place with regards to codes of conduct and creating an environment where women can feel safer and understand how we operate, especially around events and what to do if something was to go wrong. Somebody commented that, well, all of this should be in place at the portfolio company level. All the portfolio companies should already have this. Actually, they're young companies that are struggling to get dollars through the door and are concentrating on survival. And our role, parallel to them, is to help them get these things in place, help them focus on it, because you're not born with it. A bit like baby's not born with systems, processes, and controls yet. It needs someone from the outside, i.e. the parents. No company's born with all the systems, processes, and controls. And even something the size of SpaceX is clearly struggling with systems and process around safety and training and tools and all of those things. And that is par for the course, but it also depends on how much the entrepreneur and the board care about those things. Because if you do care about those things, you can put them in early. But if you don't, I humbly submit this is the outcome.
Yeah, it's a pretty fascinating article just in terms of the volume of injuries. And I guess that they're working in the space, no pun intended, of rockets and explosives and a new way of building reusable space vehicles. So there's inherent risks in that. But yeah, I think Musk being that high E entrepreneurial energy and some of the things that are probably not necessarily on his radar or being prioritized around potentially these aspects, it is that reminder as well of the leadership style and how that can influence things inside a company. And to your point, Don, the stage of the life cycle.
Yeah, something that I took away, Don, was growth versus development. And one of the quotes from the article was, employees say that the company justifies casting away anything that can stand in the way of accomplishing that goal. And you've touched on this from your time with eShack. Like, cancer is growth, and then that's a difference to healthy development. And here they're clearly optimizing for the P&L or trying to get profitability, trying to reach their goal at the expense of basic safety for the employees.
Yeah, these are often a cultural decision that the fish rots from the head. And these are decisions that are made that the goal of whether it's profits or whether it's the getting more rockets into the air or whatever it is, if that goal is the deterministic goal and there's no constraint goal around safety, and this wasn't supposed to be a beat fest. If you look at Elon's other pursuits around self-driving and the deaths around that and what happens when a product that isn't actually ready and doesn't deliver what it says on the side of the packet is used by credulous individuals that will believe the words of a demigod, the effect is some fairly significant safety issues. And so the point here is these internal systems, processes, and controls need energy. They need energy at the right time. They need focus. They're actually going to be partly a cultural thing. But at the same time, if you're an investor, don't be naive and think that scale or length of time in business or capital solves any of these problems unless you work on them, unless you actually make them a priority, unless you really put energy into it. And it's just interesting that a lot of people would think that a large company like SpaceX has all of this stuff sorted. But no, it's still an early phase company relative in its life cycle. It's still developing systems, processes, and controls. And this is one of the manifestations. And until founders and the board care enough about it to do something about it, it'll continue.
John, I know you said you didn't want this to be a beat fest, but I think this is our 15th Tribe Talking episode, and Elon's been spoken about 15 times.
Jack, there's just so much to learn from
the demigod.
That's a nice way to put it.
There's always stuff to learn. There's so many stuff in branding. Look, if you give a person the reputation as an early riser, they can sleep till noon. And Elon got that reputation as just the biggest genius on the planet. And it's only until you actually look under the hood and realize actually some personality factors of not giving a fuck, massive access to capital. I think a lot of founders would be able to achieve greatness, but they have some personality things that hold them back that Elon doesn't have. And he takes a totalitarianism approach to it, the greatest good for the greatest many. And if you've got to break a few eggs and kill a few people along the way, that's not as important as creating a multi-planetary electric car autonomous driving species. It's a values thing. That's all. That's life.
So this is where we introduce this week's sponsor, Tesla, and thank them for the support of our podcast. Boys, I am conscious of time, and I think, Don, you've got a portfolio call.
Oh, shit. I do. What are we looking forward to?
I'm heading off to facilitate a panel with Vu Tran and a couple of other founders talking about the good, the bad, and the ugly of entrepreneurship. So I'm looking forward to that right now.
I'm looking forward to going down to the Goldie with you guys on Thursday, spending a bit of time with our shareholders. Sounds good.
Thanks, boys.
See you guys.
See ya.